Thanks for tuning in to BloombergQuint. Yes, the Nifty has conquered 10,000. The question is, what's the way ahead? How are the global markets supportive as well? What are global investors thinking about what happens next post this 10,000 level? With us to talk about the way ahead is Dr. Jim Walker of Asianomics, joins us right now live. Jim, thank you so much for taking the time out and joining us. It's a special moment for all of us out here in India, as for every investor across the globe interested and invested in India as well. How are you feeling? What's the way ahead from here on?
Well, it's really not that unexpected that India should do so well over the course of the last few years. It's maybe a bit of a surprise just how well it's done this year. Global markets are up pretty substantially this year, including some in Asia. But India has been a star performer. And the question mark now for us is, has it actually run a bit of its course? We're still India bulls over a 5-year perspective, but at the moment, I've got to say that I think the market's run a wee bit ahead of itself, given some of the fundamental economic conditions within India, in particular investment cycle. That worries us slightly just now, and I have a feeling that this might actually be a very big day, but it might be about the best that we're going to get for a few months ahead.
Would you expect a correction then, Jim, even if the global markets were not to show any kind of worries?
No, if the global markets keep going the way that they are going, then India could easily run up further. But I suspect that from here on, it's going to be harder for India to outperform. It's been a decent outperformer this year. The only market in Asia, for example, that's been a better performer than India this year is Korea. But most of them are up between 15 and 20-odd%. You know, there's a lot of people barking at the back of India at the moment. And if earnings don't come through in the way that they should, if people begin to get a bit more worried about the credit conditions in India and about the investment cycle, it would be an easy time for investors to actually start taking a bit of profit here.
So I take on board your point about Korea as well. That and a few other economies, the markets have done really well. I think they're showing promise as well. But for an investor who is investing across the Asia-Pacific region or the emerging market region, what are the stronger options available for global investors aside of markets like India?
Well, actually, at the moment, and probably over the next year or so, China is going to be a major competitor for capital flows, trying to take money away from India and, of course, divert some of the capital flows that have been so supportive of the market this year into the Chinese economy and the Chinese market sector. You know, China has had 2 or 3 bad years. It started to turn around last year. We think that it's now in a multi-year upcycle. And where China is winning at the moment is in terms of its investment cycle. Investment has begun to turn up in some pretty kind of important parts of the Chinese economy. And this is where India is still lagging. And as I say, it's beginning to concern us slightly that the investment cycle hasn't kicked in the way that we wanted it to. Now, as I say, over a 10-year, 5-year period, India is still our top pick of Asian markets. But over a 12-month period, I think it might struggle to outperform some of the barking dogs at its back.
Fair call. Jim, the other question is the big worry on the mind of a few people, and that is the QT, as we may call it, which may start happening anytime soon. We don't know the timelines to that. Now, we were speaking to Ken Rogoff the other day, and he thought that the American QT will not have a big impact because QE by and large has not had too much of an impact. Now, quantitative easing, that is. Now, my question to you, Jim, is if indeed US does start pulling back, does it have a material impact on global financial markets and thereby on markets like India as well, individually?
It'll all depend on whether or not the real economic recovery continues. One of the things which has been very much at the heart of the outperformance in India and Asia generally, and to a certain extent emerging markets around the world, has been that the global economy has actually performed quite well over the last 12 months or so. That's been surprising from the European perspective. Europe has picked up more than most people were expecting. I think it's come as quite a surprise, although not to our clients, that China has turned the corner. And of course, the US continues to grow, albeit relatively slowly. But where the US is contributing just now to other parts of the global economy is that the dollar is weakening. And when the dollar weakens, that means that dollar purchasing power actually expands in places like Japan, Europe, Asia, emerging markets. And that then feeds on itself and produces a demand for exports from all of the Asian countries that are big exporters. If that continues, then even if we start to see some tapering in monetary policy or some tightening in monetary policy, then we shouldn't expect markets to do badly at all. Markets will continue to do well, especially in the economies that are growing fastest, and that still is Asia and includes India. If, on the other hand, we start to get monetary tightening when the global economy is beginning to slow down, that's not our base case, but if that were to happen, then we would see markets coming off pretty quickly right across the world. It wouldn't just be India, and it wouldn't just be Asia, it would be everywhere.
That you anticipate, Jim, if that were indeed to happen, would it be to the tune of 10-15%, or could it be more?
Always a difficult question. There are so many people out there just now talking about the extremes that we've got to in valuations and the likeness with other times of significant market corrections. The big problem that they have, though, is explaining where we are in terms of interest rate and monetary policy. Because even if we do get some degree of tapering from the Fed's balance sheet, and perhaps even from the European Central Bank's balance sheet, if it was to show any signs at all of affecting markets, these guys would reverse that tapering very quickly. So I think we're still in extraordinary monetary times. I think that the countries that deserve to have good stock markets and to have good prospects over the next few years are still those that have got relatively high interest rates and relatively high growth. That includes India, includes almost all of Asia.
Okay, let's talk about India a bit, Jim, and we'll wrap this conversation. But what next? Let's assume you mentioned that India will find it difficult to outperform the region. In the event of a correction, be it 5%, be it 10%, be it 15%, it's difficult to say that right now. Would you open up your purses and go out shopping all over again in a big way?
Oh, if we had a 10% correction, absolutely, I would be first in line to put more money into India. And don't get me wrong, I've still got plenty of my own money in India. But if there was a significant correction like that, I would be certainly expanding that portfolio again. Because, as I say, the India story is a 5-10 year story. It's not a 12-month story. Where India, I think, just slightly concerns me at the moment is when I look around the region at the cyclical aspects of the investment story. And investment for us in Asianomics is one of the key elements in the economic growth drivers. Both credit support and investment support for future earnings is relatively weak in India in comparison, for example, with China, to a certain extent with Hong Kong, with Korea, with Taiwan. And that's what concerns me. It doesn't concern me on a 5 to 10 year view. It's only on a short cyclical perspective that I think India has a little bit of a hill to climb to convince investors to keep money in the economy when that investment and credit cycle hasn't turned round in the way that it should have.
The divergence is, Jim, in terms of the earnings expectations that people have within India. A lot of people believe that there is case for at least a 17 to 20% earnings upside or earnings growth in the current year itself, and then the next year probably bakes in another 20% and then the cycle continues. There's the other side which believes that this year is 10% or 12% at best, and we don't quite know about the next year. And we all know that the markets would be a slave of earnings as well at some point of time. It may run ahead of reality, but at some point of time it will converge. What are your expectations? Do you see a CAGR 5-year earning growth northwards of 15% for Indian markets?
Not at the moment. And again, it comes back to monetary conditions and investment conditions. One of the things that has happened over the last few years is that the Reserve Bank of India has moved to an inflation targeting framework. And by that, it of course means that it's focused on CPI, which is now very low, before it would contemplate cutting interest rates. We've always disagreed with that policy. We've always thought that's been a stupid policy in the West, and it's no more sensible in India. What central banks should be looking at is the rate of growth of money and credit in the system. And both of those have been slowing down in India. Both of those really suggest that there's going to be some crimp on economic growth in nominal terms over the course of the next couple of years. So I would actually be in the camp that thinks that earnings are probably going to disappoint on the downside. 10 or 12%, in my view, would actually be pretty good earnings growth in India over the next 2 years.
Next 2 years, you're saying? You're not too bullish on earnings growth picking up even in the following year, FY19 as well?
Even in the following year. We're too far into the credit cycle and money cycle's downturn for it to pick up fast. The Reserve Bank really needs to get moving on cutting interest rates, and at the same time, the government very much needs to get moving on consolidating the banking sector and recapitalising the public sector banks. That's what would save the day in India and push the investment cycle, push the credit cycle onto an upswing again.
Okay. Where are you placed in your bets within India, Jim? You're talking about earnings not looking strong and the markets having run slightly ahead of themselves as we hit 10,000. So where are you positioned? Are you defensive right now? Is your portfolio largely defensive in nature? What are the bets that you've taken thematically? I
tend to leave the India portfolio selection to the experts that run funds in India.
Got it. But what do you like with India, Jim?
Yeah, my own bet is still that we're in the early stages, or we should be in the early stages of a capital upswing in India. And therefore, I would be more positioned into the industrials, into the construction side of the economy than I would be, for example, in finance or in consumption goods. But that's, of course, an economist's perspective rather than anybody with any market knowledge of the actual companies involved.
You're being modest, Jim. We take your opinion on board. Thank you so much for taking the time out today and joining us right here on BloombergQuint with your analysis. Pleasure. Well, that's Dr. Jim Walker believing that maybe the market has run slightly ahead of themselves even as we celebrate 10,000. Could there be some potential downside? Yes. But if the markets were to correct 10% or thereabouts, he would go out all guns blazing and start shopping. Thanks so much for watching BloombergQuint.